The stock market right now feels like a total puzzle. It's like someone dumped out pieces from two completely different boxes. On the one hand, you see the big indexes like the S&P 500 hitting all-time highs. But on the other, maybe your own portfolio is just a sea of red. So what is really going on here? Well, in this explainer, we're going to put those puzzle pieces together and show you the bigger picture that's hiding just beneath the surface.
I mean, a number like this is what's so interesting. While all the headlines are screaming about new highs, a whole bunch of last year's favorite stocks, the darlings of tech, AI, all that momentum stuff, they're down 30, 40, some even 50%. It's this brutal kind of silent crash that has a lot of people just scratching their heads. And yeah, this brings us to the central mystery. If the S&P 500 is barely down from its peak, how in the world can so many individual stocks be in a total freefall? It seriously feels like two completely different markets are running at the same time. The answer, though, it lies in this massive, fundamental shift that's happening kind of just out of sight. And that shift is what analysts have started calling a great rotation. What that really means is that the investment playbook that worked so well last year, that's been torn up and thrown right out the window. What you're seeing is money just pouring out of the old winners and into some new, pretty unexpected places. This slide really lays it all out. Just look at the contrast. Over on the left, you've got last year's champions, those high-flying, momentum-based stocks in tech and AI that seemed like they could do no wrong. And on the right, that's this year's leaders. Overlooked, defensive. You might even call them boring sectors like home builders and groceries. It's a complete 180, like all the capital just ran from one side of the boat to the other. Now, the engine driving this whole shift is a concept called reversion to the mean. The best way to think about it is like a rubber band. You can stretch it really far in one direction, which is kind of what tech stocks did last year, but eventually it's got to snap back toward its average. And that's exactly what we're seeing now. Last year's high flyers are coming back down to earth, and all those beaten down stocks are finally starting to get a bounce. Okay, so if the old rules are broken, how are people actually navigating this new landscape? Well, out of all this chaos, three really distinct strategies are starting to emerge. So let's break down how different experts are trying to find an opportunity in this seriously divided market. So this first path, this one's for the contrarians. This is all about leaning into that uncomfortable feeling and buying what everyone else is desperately selling. The whole strategy is to find sectors that have just been beaten up so badly that they're trading way below their historical norms, like their 50-day moving average. And then you make a bet on that powerful snapback from the mean reversion we just talked about. And here's some real-world examples of what that looks like. You've got contrarians looking at the software ETF IGV, basically arguing the whole sector is just too oversold to ignore anymore. They're looking at Bitcoin ETFs like BITO, where it feels like the selling pressure is just finally running out of steam. And they're even looking at defensive names like the grocer Albertsons, which is in an essential industry and has a pretty cheap valuation. All right, let's move on to the second path, which I think is just perfectly captured by this quote. See, this strategy isn't about trying to pick this quarter's hot stock. No, it's about playing a much bigger, longer-term game. This is the AI infrastructure bet. The idea here is that in a gold rush, you don't want to be panning for gold, you want to be the one selling the shovels. In this AI revolution, the play is to own the foundational layer, the chips, the data centers, the core platforms. Building this AI war machine, as some call it, costs an absolutely astronomical amount of money. And that creates a huge barrier for any new competitors. And just to get a sense of the sheer scale of this investment, just look at this number. Google, by itself, is planning to spend up to $185 billion next year on capital expenditures. And this isn't just about making search better. This is about building the very foundation that the entire AI economy is going to run on for decades. And the payoff for owning that infrastructure can be absolutely massive. Just look at a company like Palantir, which is building a kind of operating system for AI. Their revenue growth is accelerating up to 70%. But what's even more impressive is their net dollar retention is at 139%. That means they're not just keeping their customers. Those same customers are spending 39% more with them every single year. That's the sign of a really sticky, really valuable platform. Which brings us to a key metric for software companies. It's called the Rule of 40. Basically, you just add the revenue growth rate and the profit margin together. If that number is over 40%, the company is considered healthy and really well run. Palantir score, an incredible 127%. I mean, that's almost unheard of, and it just goes to show you how powerful owning that foundational AI layer can be.
All right, now for our third path. This one is a bit more of a classic value-oriented approach. This is all about finding what some analysts call Hall of Fame businesses, truly world-class companies, and then just patiently waiting for the market to give you a discount. You figure out what you believe the company is truly worth, its fair value, and then you only pull the trigger when the stock price falls below that.
Microsoft is a perfect example of this in action. After a recent little dip, its market price fell to around $423 a share. But some valuation models, like the one you see here, actually calculate its intrinsic or fair value to be closer to $465. So for these investors, that gap right there, that represents a potential opportunity to buy a world-class company at a bargain.
But of course, no strategy is ever risk-free. And for every bullish argument you hear, there's a bearish counterpoint waiting in the wings. The market right now is a total battlefield of conflicting ideas, and there are some pretty serious risks lurking just beneath the surface that we really need to talk about. Let's just use Google to see these two sides collide. The bulls, well, they see a company that owns the entire AI stack, from the chips all the way to distribution. The bears, they see a bloated giant whose profit margins are getting squeezed by the high cost of AI, all while it's facing these massive regulatory threats. This exact same bull-bear tension is playing out across the entire tech sector. But, beyond all these company-specific debates, there's a broader, more systemic risk that's been quietly building up in the background. And it's one that could affect everybody, no matter which path you decide to follow. What you're looking at right here is the year-over-year increase in NYSE margin debt. Now, that's basically money that investors have borrowed to buy stocks, and it is up a staggering 36%. That tells us that a growing chunk of the market's recent gains has been fueled by leverage, by borrowed money. And here is why that is such a red flag. Historically, when margin debt growth gets above 38%, it's like a warning shot for the market. Why? Well, think of all that borrowed money as fuel on a fire. When the market turns down, it can trigger margin calls, which forces investors to sell, which makes the downturn even worse. And we are right on the edge of that danger zone. So with all these conflicting signals flying around, this big rotation, the different strategies, and a major risk like leverage building up, how do you even begin to make sense of it all? Well, seeing these risks doesn't mean you run for the hills. It just means you need a really clear framework. The goal here isn't to give you the answers, it's to help you ask better questions. So here's a roadmap that kind of summarizes the frameworks we've covered. First, you got to spot the rotation that's happening. From there, you can look for opportunities by finding the extremes, whether that's through those contrarian plays, the infrastructure thesis, or hunting for undervalued quality. And then crucially, you have to weigh any potential reward against the very real systemic risks. And all of this brings us to the core question that you should probably be asking yourself. In this new market landscape, which is being defined by this great rotation and the rise of AI, is your strategy going to make you an owner of the foundational infrastructure, or will you just be a renter? Your answer to that question is going to be a critical guide for your investment decisions in the years ahead.